Most people think not investing is the safe option. No market crashes, no volatility, no risk, just save money and avoid the stress. Sounds responsible, but what if the safest financial decision you can make today quietly becomes the most expensive mistake of your life?
Revenue's up 85% year on year. The guide was good. The buyback of $80 billion. They raised the dividend. The data center.
JP Morgan up about 1% after a beat on both the top and bottom lines.
8% this week. And a lot of times it was borne out. And by the end of this month, we're going to be significantly higher.
Accelerating growth versus consensus of 27% growth.
8,250 by the end of the year and 10,000 by the end of the decade.
Recently has said best couple of years that we're going to see in the stock market in his lifetime.
Because while millions of people worry about losing money in the stock market, something far more dangerous is happening in the background. Your cash is losing value every single year, and unlike a market crash, you'll never see it happening. No warning, no headlines, no panic, just a slow decline that can cost hundreds of thousands of dollars over a lifetime. The shocking part is that many people who never invest don't realize the damage until decades later, when retirement arrives and the math no longer works. Most people think the danger of never investing is missing out on stock market gains. That's not the real danger. The real danger is that your money slowly loses its ability to buy the things you actually need. Imagine you save $50,000 and leave it untouched for the next 20 years. The balance never goes down, you never lose a dollar. Every time you log into your account, that same $50,000 is still sitting there. Sounds safe, but money isn't valuable because of the number attached to it. Money is valuable because of what it can buy. And that's where the problem begins. Every year, the cost of living creeps higher. Groceries cost more, housing costs more, healthcare costs more, travel costs more. The dollars sitting in your account stay exactly the same while the world around them gets more expensive. Most people never notice this happening because it happens slowly. There's no warning message from your bank, no notification that your purchasing power just dropped, no headline telling you your future retirement became a little more expensive overnight. It simply happens in the background, year after year, decade after decade. Eventually, the impact becomes impossible to ignore.
Financial function had failed, and we had to restore them.
Did you think it was a radical policy?
I most certainly did think it was a radical policy.
The Fed inject money into the economy.
Fueled by recent government stimulus programs.
When the Fed changes to the primary engine of economic growth, it's supposed to be our democratic institutions that do that, not the central bank.
And an uncertain future.
Pain for American families.
It's not just that we're getting more calls, it's that the folks who are calling us are in greater distress.
The money that once looked like a comfortable nest egg suddenly doesn't stretch nearly as far as you expected. And the longer the timeline, the more severe the damage becomes. This is why keeping large amounts of cash for decades isn't actually a conservative strategy. It's a strategy that guarantees your wealth loses value over time. But losing purchasing power is only half the story. Because while your cash is quietly falling behind, people who own productive assets are benefiting from something that completely changes the outcome. Let me ask you something. If someone offered you a guaranteed way to avoid every stock market crash for the rest of your life, would you take it? No bear markets, no scary headlines, no watching your portfolio drop 20%. Just cash sitting safely in the bank. A lot of people would say yes. But what if avoiding every market crash also meant giving up hundreds of thousands of dollars in future wealth? Would that trade still be worth it? Let me know in the comments. Because once you see what compounding does over a lifetime, the answer becomes a lot more complicated. There's another reason so many people never invest, and it has nothing to do with math. It's fear, not fear of losing everything. Fear of losing anything, because watching a savings account never goes down feels comforting. You can log in whenever you want. The balance is stable, predictable, controlled, but investing asks you to accept something uncomfortable, short-term uncertainty. Some years your portfolio goes up, some years it goes down, and for a lot of people, those temporary declines feel like failure. This is why millions of investors panic during market downturns, not because the fundamentals changed, not because the world ended, but because seeing red numbers triggers an emotional response. Humans naturally feel the pain of losses more strongly than the joy of gains. In other words, losing $1,000 hurts more than gaining $1,000 feels good. And that psychological bias causes people to make decisions that feel safe today but become expensive tomorrow. Think about it. If someone offered you two choices, option 1, guaranteed comfort today. Option 2, greater wealth 20 years from now. A surprising number of people choose the first option. Not because it's the better financial decision, because it's the more comfortable emotional decision. And that's the trap.
Lehman Brothers was a significant and important player in the 2000s in the US, in the investment banking industry. At that time, it was number 4.
If you're emotional about investments, you're not going to do well. I mean, facts are facts and reason is reason. In investing, there are no called strikes. I can look at 1,000 different companies, and I don't have to be right on every one of them, or even 50 of them, or even 25 of them.
The stock market doesn't just test your money, it tests your patience, your discipline, your ability to ignore short-term noise. The people who build wealth aren't necessarily smarter. They aren't better at predicting the future. They simply understand something most people don't. Temporary volatility and permanent loss are not the same thing. A market decline can recover. Lost decades of compounding never do. And once you understand that difference, the entire conversation about investing starts to look very different. Now let's see what this decision actually costs. Imagine 2 people. Both start at age 25. Both invest the same $500 every month. Both stay disciplined for 40 years. The only difference is where the money goes. The first person keeps playing it safe. They put their money into savings and avoid the stock market completely. The second person invests in a simple S&P 500 index fund. Fast forward to retirement. The saver ends up with roughly $366,000. Not terrible. Most people would look at that number and think they did pretty well. The investor? Approximately $2.6 million. Same income, same monthly contribution, same 40 years. One decision created a gap of more than $2 million. That's the hidden cost most people never calculate. When people avoid investing, they focus on what they might lose. They rarely think about what they're giving up. And that opportunity cost gets larger every year. It's hard to appreciate how big a $2 million difference really is. On paper, it just looks like a larger number. In reality, it creates 2 completely different lives. One person reaches retirement wondering whether their savings will last. The other reaches retirement wondering what they want to do with the next 25 years. One worries about every major expense. The other has room to absorb unexpected costs. One delays vacations, the other can afford to take them. One may need to continue working longer than planned. The other has the option to walk away. That's what makes investing so powerful. The biggest benefit isn't becoming rich, it's creating choices. Most people think wealth is about luxury. For many people, wealth is simply having options. The option to retire when you want. The option to help your children. The option to handle emergencies without panic. The option to spend more time with the people you care about. Money doesn't solve every problem. But having more financial flexibility solves a lot of problems that become increasingly difficult later in life. And that's why the difference between hundreds of thousands and millions of dollars matters so much more than most people realize. Of course, this is where most people bring up market crashes. What about recessions? What about 2008? What if I invest right before everything falls apart? It's a fair question. The stock market has gone through wars, recessions, banking crises, inflation spikes, political turmoil, and some of the biggest financial panics in history. Yet despite all of that, the long-term trend has remained remarkably consistent. The people who benefited weren't the ones with perfect timing. They were the ones who stayed invested long enough for time to do the heavy lifting. Meanwhile, cash faced a different problem. It never crashes, but it never really compounds either, which creates a problem that doesn't show up until retirement. Because retirement isn't about how much money you saved, it's about how much income your savings can generate. Someone retiring with a few $100,000 may be forced to carefully budget every expense. Housing, healthcare, travel, unexpected emergencies, every dollar matters. But someone retiring with several $1 million has options, more flexibility, more security, more freedom, and that's really what investing buys. Not a bigger account balance, not bragging rights, not fancy charts. Freedom. The freedom to make choices later in life that simply aren't available to people who spent decades sitting on cash. Which brings us back to the original question, is never investing actually the safer choice? Or does it only feel safer because the risks are harder to see? So, what happens if you never invest? You probably won't go broke. You can still save money, you can still build an emergency fund, you can still retire someday. But every year you spend avoiding risk, you also give up the thing that has created wealth for generations: time. Because investing isn't really about picking stocks, it's not about beating the market, and it's definitely not about getting rich overnight. It's about owning assets that grow while you sleep. The longer you wait, the more expensive that decision becomes, and unlike a bad investment, you never get those lost years back. So is never investing worth it? For most people, probably not. Not because investing is perfect, not because the market is guaranteed, but because the cost of doing nothing is often far greater than the risks people spend their lives trying to avoid. If you enjoyed this video, subscribe for more financial reality checks. And watch this next video, because there's another financial rule most people follow without question, and it could be costing them far more than they realize.